Hi everyone, my name is Joseph-Antoine Migdelani. Today I am with Karim Zakir, our portfolio manager. Welcome to our quarterly web capsule. Before we start, I want to remind you that the reason why we do these capsules is to inform, educate, and keep you posted with the world of finance. Don't forget to subscribe if you like our videos and to share with families and friends. We're gonna be very happy if you do so. And if you have any question, don't hesitate to reach us after the video. So because we are in the tax season, I just want to start by two little points. The first one is that Government of Canada decided to remove his new rule with the tax inclusion for the capital gain. We're going back to the original, where 50% will be taxable on capital gain.
That's great news. Of course, it happens during an election period, but we'll take it. It's candy, and we'll definitely take it. And we'll see what happens in the future if they reverse that rule again after they get elected. But anyway, that's another story.
Exactly.
We'll see, but we'll take it.
Absolutely. And the second point is that I wanted to let you know that all the tax slip or fiscal documents are now available online. So for our clients, you could go on our website or National Bank Financial website to get that and to send it to your accountant before April 30th for the tax of 2024. So now let's talk about the market, right? How do you feel, Karim, about the market right now? And let's talk about the first quarter a little bit as well.
Yeah. So the first quarter, Joseph, it's been quite rocky.
It was.
Okay.
Yeah.
Two words. Tariff, Trump. That's all I gotta say. Thing is, we've had a correction in the month of March. These corrections happen. 10% corrections for the S&P 500 tend to happen every 18 months on average.
Yeah.
So we're pretty much at that point. And there is a new index that's out. It's called the Macro Research Economic Policy Index that exists since 1985. It measures the level of uncertainty among investors in the US in particular.
Might be pretty high right now.
It's at a peak.
Yeah.
And whenever it's at a peak, the S&P 500, after the correction occurs, the S&P 500 has a tendency to go up 80% of the time.
Really?
With an average return of 8.8%. Now, nothing's guaranteed, nothing's set in stone,
Sure.
but we'll take it.
Yeah.
We'll take it. I think it's a positive index. So when we reach peak uncertainty, honestly, it's the time to be buying, not selling. And I'm going to give you examples, very recent examples, that most people already most likely forgot.
Yeah.
The corrections of 2018, 2020, and 2022. Some people are going to say, we had a correction in 2018? We certainly did. It was Trump 1.0, was his first mandate.
Yeah.
The fourth quarter of 2018, particularly between Christmas and New Year's, we had a pretty big drop in the markets for the exact same reason, Trump, tariffs. What happened afterwards is 2019, well, the markets went up. 2020, I think everybody remembers that one. It's the pandemic where we had a V-shaped correction.
Yeah.
We've had cases, some clients who couldn't take it. This was the end of the world. They wanted out. I got them out. Unfortunately, at the wrong time. I suggested not to do that. They did it anyway. Some of them did it anyway. The majority, 99%, listen, but 1% do what they feel is best for them, which is fine. I totally respect that. And they liquidated at the worst possible time. And what happened? The central banks plowed a lot of liquidity into the world markets. And guess what happened? Market rebounded. And it actually, the year 2020 was a positive year for the market, believe it or not.
It was a good year, yeah.
It was not greatly positive, but it was positive. Where we were down like 20 to 25% at one point.
Remember.
And then the most recent correction, other than this one, is 2022. If you remember, interest rates were virtually at zero, and the central banks raised rates all the way up to like 5%. I shouldn't say all central banks. The U.S. Federal Reserve did, and Canada followed. So rates went up really fast. And we had a market correction and a bond market correction, because when rates go up, bonds go down simultaneously. And we only saw that 4 times in the last 100 years, where the bond market and the stock market drops at the same time. Joseph, what happened in 2023 and 2024?
Amazing years.
Phenomenal years afterwards. Talk to people in 2024. Remember that correction? What correction? They completely forgot. But when it was in the middle of the correction, it's like the end of the world. We should get out. We should try and time it and get back in. No, no, no. It's a big, big mistake to time the markets. Okay, I keep saying that. So this is another correction where discounts are almost everywhere. The main reason for this correction exactly is Trump and tariffs, but what sector really dropped? It's the Magnificent Seven, which was the best performing sectors over the last 2 years. So the Mag 7, which is really implicated in the artificial intelligence, is not to be avoided. You got to stay in. It's the future, artificial intelligence. A lot of companies are integrating this technology in their business network. It's happening more and more. And so we're at the infancy stage, and I believe it has a long way to go. The other 493 of the S&P 500 stocks held pretty well, but it's really the Mag 7 that really took a dive. So I do see it coming back.
And what about Tesla, Karim?
So for those who hold the discretionary portfolios, we sold Tesla. We sold the entire position for the simple reason that it's become, unfortunately, too political and too toxic. It's too bad, because we bought Tesla in January 2023 at about $142 to $143 USD a share.
USD, right.
We exited the position entirely at 308. Clients made over 100%. And in addition to that, I had sold even prior to that in the 400 range for some clients. Well, most clients, because I rebalanced portfolios, and so we took some profits off. But we sold the entire position at 308 this quarter. So for those who want to know what we purchased instead of Tesla, I will refer you to our quarterly mandate, our quarterly brief letter that we send out to all our discretionary clients only, which discusses the ins and the outs, what we bought, what we sold. So we may revisit Tesla, because I think it's a phenomenal company. I love the product. They're the most advanced in EV technology of any other car companies. And so we will revisit if Elon gets out of the government or out of Tesla, one or the other. We'll reconsider it.
Good to know.
So I just want to repeat, it's an ideal time to remain invested. And if you're sitting on cash on the sidelines, it's a fantastic time to get in, because in a year or two, this correction will be forgotten as well.
Absolutely.
And I can assure you that most likely your portfolios will be going up over the next 5 years. Maybe not up over the next 5 months, but over the next 5 years, your portfolios will most likely go up. Just want to give a couple of examples to prove to you that we're not traders. We're more of a buy and hold type of investor. We had bought Apple, the stock, back in September 2013. We hold for a long time. I'll hold forever if I could, okay? And we bought the stock at 17 USD per share, pre-split, adjusted to all the splits. Today, as of April the 1st, the stock is at $223 a share. Now, when it was at 17, it did go to 50. It dropped back down to 30. Some clients are saying, why didn't you get out at 50? It's because I'm a buy and hold. I don't trade. Why don't we trade? It's very taxable. It's a lot of work for your accountant, and it's not the right approach to investing. That's not how you generate wealth, by trading in and out. Most traders have a hard time making money because they don't know the direction. It's especially with Trump there. We don't know what to own. So the key is to own a little bit of everything in the right sectors as best as we can, and hang tight. And that's a performance of over
That's amazing.
tenfold.
That's amazing. There's gold as well, I think.
Gold is another one where we buy and hold. We had bought gold, the Royal Canadian Mint, which is kind of like a certificate that trades. It reflects gold bullion, not gold mining companies, but gold bullion. We bought that in January 2018 at $17.67 a share. Today it's at $48 a share Canadian, okay? And I can tell you gold is under-owned. People don't like gold. I don't know why. Gold is a refuge when things go bad.
Yeah.
And gold is an excellent portfolio diversifier. Everybody should hold gold, and all our discretionary portfolios have quite a significant holding in gold. And it's under-owned, and I believe gold's going to be going higher.
And I also think, Karim, that a good example you could give is 2022, when the market, like bonds, stocks went down, gold went up.
Exactly, and if actually I look at gold's performance over the last 3 years versus the S&P 500, gold has done a performance of 16.87%
Very good.
annually over the last 3 years versus the S&P at 9%.
Wow.
Which goes to show diversification creates great opportunity.
Yeah.
It lowers your volatility and it enhances your return. And that's what I call alpha. You want to get those performing pieces in your portfolio that create that alpha. And I'll just finish by saying the S&P in the first quarter lost 4%. The TSX was a little bit above being flat. And the good news is all our portfolios, whether you have the most conservative of them all, which is the revenue portfolio, all the way up to the max growth portfolio, the performance is at least 1%, if not higher, for all our discretionary portfolios
Great news.
in the first quarter. So I'm very happy to see that. And I'm going to finish with, if you're not comfortable with volatility, I'm going to repeat this, and I tell this often to clients, if you're not comfortable with seeing your portfolio being volatile, dropping 5%, even 10% in any one moment, in order to make more money down the road, if you're not comfortable doing that, put your monies in a GIC. They'll give you 3%, but know this, inflation is 3%, and then you get taxed on the 3%, so you lose 1.5%, because most people are at 50% tax bracket. You're guaranteed to have a loss of 1.5% if you buy these types of products. Yeah, it won't go down. The value of your money will go down. So this is where diversifying, holding stocks, holding bonds, holding gold, holding euros, holding USD, holding yen, holding Australian dollars makes all the difference in your portfolio over a longer period of time. And when I say long term, I'm always focused on 5 years.
Yeah. Well said. Thank you, Karim. I want to remind you, like I said at the beginning of the video, that if you have any questions, concerns, feel free to reach out. We're here to help and to assist. And I want to say thank you for listening to the video, and we'll see you soon.